For decades, Warren Buffett has used the strategy known as value investing, which he learned from his mentor, Ben Graham. They both love taking advantage of market volatility or the wild ups and downs of the stock market to make billions of dollars. By the end of this, you will understand how to invest like them and how to use market volatility to your benefit. First of all, what is value investing? Value investing is the strategy of looking for undervalued or cheap companies to buy and expecting their stocks to go up in the long run. If the value of a stock is $2 and it's currently selling for $1, it is cheap. So you should buy it and hold on to it until the stock price reaches $2. How do you calculate the value or price? You can price a company based on its financial health, using metrics such as earnings, earnings per share, and so on. When Buffett and Graham shop for companies to buy, they try to get the biggest bargain possible. They don't want to spend $1.90 to buy a stock that is worth $2 because they want some wiggle room or margin of safety in case they are wrong. A margin of safety is the difference in value between what it's really worth and its current market price. The higher your margin of safety, the bigger the potential reward and the lower the risk. Value investing is based on the fact that the market will eventually readjust and the stock price will match its true value. This is known as mean reversion. Stocks will not stay underpriced or overpriced forever, regardless of how crazy the investors get. What separates Buffett and Graham from the average investor is their view of market volatility. This is something you need to master if you want to be successful in investing. When the market crashes, the average investor usually makes a mad dash for the nearest emergency exit. But Buffett and Graham welcome the crashes as opportunities to find great investments for a fraction of the price. They know the real value of these companies beyond what the stock prices show. To them, the crashes are basically Black Friday sales for the stock market. If you're enjoying this video so far and finding it helpful, make sure to hit that subscribe button down below for more videos like this. Like taxes, volatility is basically guaranteed, but you do have two ways to protect yourself. One, dollar cost averaging. Do you ever worry about, what if I go all in and the stock crashes right after? Dollar cost averaging helps with that. Instead of buying a stock all in one shot, you split it into equal dollar amounts and invest them every week, month, and so on. 2. Bonds. Graham recommends putting 50% in stock and 50% in bonds, so your money is protected. He believes the first priority is protecting your money and the second priority is growing it. On the other hand, Buffett prefers stocks over bonds at a 90-to-10 ratio, since stocks tend to earn more in the long run. There is no one-size-fits-all to investing because it all comes down to your personality. Both Buffett and Graham recommend figuring out what type of investor you want to be. They are both active investors, which means they commit a tremendous amount of time and energy to research and analysis to find the best deals. But some of you might not want to be that. You might say, I have a life and I don't want another full-time job. That's fair. You can be a passive investor and do little to no work, but still get most of the credit. Passive investors are like the people you carry in group projects, but this time, you get carried. The returns might be lower, but all you need to do is buy and hold funds that follow an index like the S&P 500, which tracks the top 500 US companies, and you will get the average market return. However, for those of you that want to invest full-time, Buffett and Graham warn that beating the market is much easier said than done, and most people will fail. When you become an active investor, you're trading your guaranteed return for a chance to beat the market. Regardless of which approach you use, you have to be aware of one thing. If you're not aware of this, you will be making Wall Street rich instead of yourself, and that is fees. This next video will uncover Wall Street's dirty little secret and how they hide fees from you in plain sight. I will also teach you how to avoid these mutual fund fees so you keep more of what's yours.